Good morning. I'm Ong Ai Boon, Director of the Association of Banks in Singapore. Welcome and thank you for attending this morning's masterclass on the SORA market compendium. If you had attended yesterday's masterclass on the corporate guide, welcome back. Today's masterclass focuses on and will deep dive into the legal issues involved in the SOR to SORA transition. And for this, we have invited three partners from Allen Gledhill who will provide the presentation, followed by a Q&A session. They will then be joined by legal representatives from the banks. And the Q&A session will be moderated by Lam Chee Kin, who is the chair of the legal work group and the MD, Head Group Legal Compliance of DBS. Now, please use the Pigeonhole portal to submit your questions throughout the presentation. And the questions will be addressed by the panelists during the panel session. At the same time, we would like to receive your feedback on today's session, which will be in the same Pigeonhole. And now it's my pleasure to introduce the partners from Allen Gledhill, Mr. Kok Chi Wai, Mr. Francis Mok, and Mr. Glenn Fu. Over to you, guys. Thank you.
Thank you very much, Mrs. Ong, for your opening remarks. I'm Kok Chi Wai. I'm a banking partner from Allen Gledhill. Over the next perhaps 45 minutes, 1 hour, we're going to run through some of the legal issues associated with the transition from SOR to SORA. And for this purpose, and I'm sure everyone in the audience will be aware, a compendium has been produced by ABS and the steering committee for the transition with us giving legal input that sets out and maps out the reasons for the change. And I'll just move on, saturate to the next slide. It's a market guide on the application of SORA across all product clauses. It's meant to facilitate and drive adoption of the use of the SORA, or the Singapore Overnight Rate Average, our equivalent of the risk-free rates in Singapore. And the SORA goes into the reasons behind the need for the transition to SORA, and it sets out the nature, the methodology, and the features of a SORA. The compendium is, in my view, very noteworthy in the sense that it runs through the issues that are pertinent across 4 product groups, being derivatives, which my fellow partner Francis Mok will speak on, capital markets products, which my fellow partner Glenn Fu will speak on, loans, which I will touch on, as well as consumer loans. So without further ado, we'll dive straight into the legal issues, starting with derivatives, and I will hand everyone over to Francis Mok, my fellow partner.
All right, thanks, GY. This is Francis. Thanks for joining us today. So starting with derivatives as the first product class. So basically at present, Sing dollar interest rate derivatives typically refer to SOR. Right? That's the floating rate option used for interest rate swaps. And going forward, the transition that's supposed to take place is that they will reference SORA instead of SOR. So this slide sort of sets out a very broad level what we're going to cover over the next few slides. But first, before we go into that, a brief explanation of what SOR is and why the transition needs to occur. SOR stands for the swap offered rate. Right? It's published by ABS's benchmarks company, and it is basically the NFX implied rate. It's a synthetic cost of borrowing Sing dollars by taking the cost of borrowing US dollars and then swapping it into Sing dollars. So the inputs into SOR are USD LIBOR, which is the cost of borrowing US dollars, together with the US Sing dollar exchange rate. So SOR needs to be discontinued because USD LIBOR will eventually be discontinued. Why is that happening? USD LIBOR is one of the so-called IBORs, the interbank offered rates. So these are the rates at which banks will lend to each other in the interbank market for the relevant maturity period, like 1 month, 3 months, or whatever. So I'm sure you have read in the news over the last few years that there have been problems with attempted manipulation of the IBORs. Right? And that's come about because banks' sources of funding have changed over the years, and they no longer lend to each other that much in this manner. So as a result, when banks make their submissions to the benchmark administrators for LIBOR and the other IBORs, these are based on estimates produced by the banks instead of being grounded on actual transactions. So because these are estimates, these are prone to manipulation by the bankers who make those submissions. And therefore, there's a move internationally to move from the IBORs to so-called risk-free rates. Right? Risk-free rates are rates at which banks lend to each other on an overnight basis. They're referred to as risk-free rates because the loan is so short that there's very little credit risk. Right? If you lend to a borrower bank this evening and the borrower bank is solvent this evening, there's a good chance that it will also be solvent tomorrow morning when it's supposed to pay you back. So those are the risk-free rates. And in the Singapore context, SORA is the risk-free rate that is supposed to replace SOR. Okay, so moving on to what exactly SORA will mean in the context of derivatives. So ISDA has published a definition of a new floating rate option called SGD SORA compound. So this has been published as a supplement to the 2006 ISDA definitions. So going into a little about what SORA actually is. SORA stands for the Singapore Overnight Rate Average, and it's an overnight rate, as I mentioned earlier. So it means that this is the rate at which banks will lend to each other on an overnight basis. And it's an average rate, i.e. you read SORA every day because it's a daily rate over each banking day in a particular interest period or calculation period, and then you average it out. And that's how it's derived. But it's not a simple average, it's a compounded calculation, so that essentially you take the rate each day and you multiply it across the rate on all the other days before you do the averaging. SORA is published by MES. It's published on a daily basis, and MES also publishes 1 month, 3 month, and 6 month compounded averages of SORA on a daily basis. Right, so how do you use SORA in your interest rate derivatives? It's simple. It's just like any other floating rate option. You will specify SGD SORA compound as the floating rate option in a swap confirmation, and you'll incorporate the 2006 ISDA definitions into the transaction because that's where SGD SORA compound is defined. And that's done either by referring to the 2006 definitions in the swap confirmation or by incorporating those definitions in your ISDA schedule to the ISDA master agreement. Okay, what do SORA confirmations look like? For the most part, it's very similar to SOR confirmations. So ABS has published 4 template confirmations for use by the industry. These are basically listed on the slide. So the first is your sort of plain vanilla fixed to floating interest rate swap. One party pays a fixed rate and the other pays a floating rate that is pegged to SORA. These swaps will be referred to as OIS instead of IRS, which is the typical term now being used to refer to interest rate swaps. OIS stands for overnight interest rate swap or overnight index swap. So that's what people use to refer to these swaps that are based on the risk-free rates. The second confirmation is a cross-currency swap. So this will be the usual cross-currency swap that corporates and other end users will enter into with banks and other swap providers. So there will be an exchange of notional amounts at the beginning. Right? One party pays a Sing dollar notional amount, the other party pays a US dollar notional amount, and these amounts get swapped back at the end of the swap. And over the term of the swap, parties will pay floating rates. One party will pay a floating rate based on SORA, and the other party will pay a floating rate based on USD SOFR. Right? And one thing to note is that the notional amounts here will remain fixed throughout the life of the swap. So in other words, the same Sing dollar and US dollar notional amounts will be used as a basis for calculating the interest payments throughout the life of the swap. This does increase the sensitivity of the swap to FX risk for the parties. So in the case of an inter-dealer swap, right, when banks or dealers enter into currency swaps with each other, they usually enter into a swap in the form of confirmation number 3, which is the mark-to-market currency swap. This is basically the same as template number 2. It's also a cross-currency swap, but the difference here is that for the USD notional amounts, they will change throughout the life of the swap. Right? At the beginning of each calculation period, the new USD notional amount is calculated by multiplying the Sing dollar notional amount with the prevailing USD and SGD exchange rate. Right? So again, this is the typical format that these swaps will be done in for interdealer swaps. Then the fourth confirmation, which is essentially a basis swap, right, where one party pays a floating rate based on SORA and the other party pays a floating rate based on SOR. In practice, rather than using this structure, it's more likely that parties will choose to enter into two swaps at the same time. So one will be a fixed to floating swap with the floating pegged to SOR, and the other will be a fixed to floating with the floating pegged to SORA. So taken together, the economic effect of these two swaps will be the same as template number 4, but the benefit of that is that the users can then manage their exposure to SOR and SORA independently. Right? In particular, a user will be able to compress or reduce his exposure to SOR while retaining the exposure to SORA on the other leg. Right? So if you choose to do that, for the fixed to SORA leg, the confirmation that will be used will be template number 1. Right, next, this table sets out a comparison of how interest rates will be calculated for SOR versus SORA swaps. And of course, individual swaps can differ from this. Right? The parties can choose to define the interest rates or interest periods however they want. But these tables reflect the usual market conventions, and the template confirmations that we just discussed are drafted on this basis. So starting with SOR in the middle column. So an interest rate calculation under SOR is determined in advance. Right? SOR is a so-called forward-looking rate. So you measure the rate at the beginning of the calculation period, or rather before the calculation period. So a SOR reading is taken on a single day, and under the ISDA documents, the usual convention is that the reset date, which is the date on which the interest reading is supposed to be taken, is defined as the first day of the calculation period. Right. When you actually look at how it's defined under SGD SOR VWAP, the actual reading is taken 2 Singapore and London banking days before the first day of the calculation period. So what you do essentially is on that day, you take the reading of SOR for the relevant maturity period, which is 1 year or 1 month or 3 months or whatever your interest rate period is, and that will be the rate that applies for the upcoming calculation period. And therefore, for each calculation period, you'll already know at the start of the calculation period what the interest amount payable for that calculation period will be. In contrast, for SORA, the interest rate determination is in arrears, which means the interest is calculated at the end of the calculation period. Right? So the reset date is to be specified in the SORA confirmation as the last day of the calculation period. That's the market convention. Although in practice, it's not very important because, as we discussed just now, you're actually taking a SORA reading on every banking day during the calculation period. Right? So because you have to take every day's reading over that calculation period, you will only be able to calculate the interest payable in that period on the last day of the calculation period. So this difference has an impact on the payment dates that you select for the transaction. Right? So in the case of SOR swaps, the usual convention is that the payment date will be the last day of the calculation period. And that's not a problem because, as we've just discussed, you will already have known at the beginning of the calculation period what the relevant interest amount that you'll be paying. In contrast, for SORA, because you're only going to know what the interest rate is at the end of the calculation period, if you also specify that the payment date is the last day of the calculation period, this will give rise to a practical problem because people will only have a few hours to arrange payment of that interest amount. So this is difficult, and therefore the usual market convention is to opt for delayed payment of 2 business days, i.e. there will be a line in the swap confirmation that says delayed payment 2 business days, and this means that the actual payment date will be 2 business days after the last day of the calculation period. So that's the usual market convention, but when you're actually drafting a SORA swap confirmation, it's important to think about whether this payment delay is appropriate or whether it will cause problems in the context of a transaction. So for example, if you have a swap that's supposed to hedge another transaction such as a loan, you'll have to ask yourself, what's the payment date under the loan And is it okay if the payment date under the swap is different from the one under the loan? A related issue is that even though both your swap and the loan may have a floating rate that is pegged to SORA, the actual way in which SORA is determined under the two transactions might differ. In particular, there are different ways to address this issue of knowing the interest amount in time for the payment date. So delayed payment is just one mechanism, right? There are other ways to address the issue. For example, and these are just a couple of examples. One way is to take readings throughout the same interest period as we've just discussed, but to sort of freeze the interest reading in the last few days. I.e., let's say that your interest period is the month of March, 31 days in March, but you might say that after the 25th of March, for example, you will not take any further interest rate readings for that month. So for the 26th, 27th, and onwards, the interest rate is deemed to be the same as the one on the 25th of March. So this will let you know the rate well in advance of the 31st of March, if you want that to be the payment date. Another way is to have a different observation period. So i.e. you shift the dates on which interest rate readings are taken to an earlier period. So in the month of March, again, you might shift the dates on which interest rate readings are taken to, let's say, the 25th of February to the 25th of March. So this shift in the so-called observation period is going to be common in loans. So if you have a swap that's supposed to hedge obligations under a loan, it's again important to be aware of that potential difference and to ask yourself, is that a problem and do you need to adjust the swap terms for it? Okay, so we've talked about SORA derivatives. So now we're moving on to talk about what needs to happen for SOR derivatives. So on a broad level, what's supposed to happen is that people have to stop entering into SOR derivatives in due course and start transacting in SORA. Right? That's sort of a practical or commercial issue. The legal issue for SOR derivatives is what happens to a SOR derivative when publication of SOR eventually ceases. Right? So the expectation was that publication of SOR will cease at about the end of 2021. Right? So you'll have seen in the news recently that there are consultations going on in the US and the UK, and that may potentially be pushed back in some aspects at least to the middle of 2023. But again, in the event that publication of SOR ceases, what's going to happen to existing SOR derivatives that reference SOR? The existing ISDA terms do provide for fallbacks for all of the IBORs, including SOR. But these fallbacks are designed to address the temporary unavailability of rates rather than the permanently cessation of publication of a rate. Right? So for example, for SGD SOR VWAP, the fallback relies on polling banks in the London interbank market for what are the rates on which they will lend to each other for the relevant maturity period. So in a world where USD LIBOR has ceased publication, you may not be able to get banks to provide such quotes. So if you are not able to provide these quotes, the ISDA documentation doesn't provide for what's going to happen. So essentially, the parties will not know what payments to make at the next payment date. Even if you are able to obtain such quotes, they may vary a lot from each other because it's not a real market in these products, and therefore this will introduce basis risk into the parties' transactions. So it's not a satisfactory situation and needs to be addressed somehow. And the approach that ISDA has taken is to basically let national working groups, based on government and private sector representatives, to determine what will be the most appropriate fallback in the case of each IBOR. So in the context of SOR and for derivatives, it's been decided that the fallback rate for SOR will be something called fallback rate SOR. So fallback rate SOR will be published by ABS Benchmarks Administration Company, just like SOR, and publication has been going on since September 2020. Fallback rate SOR is very similar to SOR. Just like SOR, it's an FX implied rate. which is based on the rate for borrowing US dollars and then swapping it into Sing dollars. But instead of using USD LIBOR as the rate for borrowing US dollars, it uses fallback rate SOFR, which is the fallback rate for USD LIBOR, and it's a rate that's published by Bloomberg. So the reason for choosing fallback rate SOR is that because it's so similar to SOR, it very closely tracks the amount of what SOR is. So that correlation should reduce the risk of value transfer when the market transitions to this fallback rate. Right, so how do we incorporate this new fallback into ISDA transactions? So that's done via one of two documents published by ISDA. These were both published recently in October. So the first is what's commonly referred to as a fallback supplement. This is essentially a supplement which amends the 2006 ISDA definitions. And what it does is to amend the definition of each of the relevant IBORs, and including SOR, to incorporate the new fallbacks that are based on risk-free rates. And the effective date of this amendment is 25th January 2021. Right, so essentially, if you enter into SOR transactions after that date, and you refer to the 2006 ISDA definitions, this will automatically incorporate the new fallback rate SOR as a fallback in the event that SOR ceases to be published. So that's for new transactions that you enter into after that date. For existing transactions, which you enter into before that date, there's a separate document called the Fallbacks protocol, which is meant to help users to transition to that smoothly. So we'll go into what that does in the next slide. But for now, just note that both the supplement and protocol basically do the same thing. Right? They amend the ISDA definitions of SGD SOR VUAP to say that upon a so-called index cessation event, fallback rate SOR will be the applicable floating rate option instead of SOR. Right? And in the context of SOR, an index cessation event will essentially include USD LIBOR ceasing to be published or SOR itself ceasing to be published. Right, now taking a closer look at the Fallbacks protocol, ISDA refers to this as a multilateral contractual amendment mechanism. And basically what it does is to provide an easy way for a market participant that's entered into ISDAs with many different counterparties to amend all of those agreements without having to individually sign amendment agreements with each of those counterparties. So the way it works is that the protocol is basically an amendment agreement. Right? It says that an existing ISDA master or confirmation will be amended to the extent that it refers to an IBOR to incorporate the new fallback rates. So a party that is willing to be bound by this amendment will sign up to the protocol by signing an adherence letter and submitting it to ISDA via the ISDA website. And ISDA will publish on its website all of the parties who have signed up for the protocol in this way. Right. So on the effective date of the protocol, which again is January 2021, all of the parties who have signed up to the protocol, if they have entered into ISDA master agreements with each other, those agreements will then be deemed on that date to be amended to incorporate the new fallbacks. So for example, if a company A has entered into ISDAs with companies B and then also with companies C and companies D, and let's say A, B, and C have all signed up for the protocol before the effective date. So on the effective date, the agreements between A and B and between A and C will be automatically amended to incorporate the fallbacks. They don't have to do anything other than that. So in the case of the agreement between companies A and D, that agreement will not be amended in this way because D hasn't signed up for the protocol. Right? But if after the effective date of the protocol, let's say in the middle of next year, company D decides to sign up for it and submits the adherence letter to ISDA, then on the date that it does so, the ISDA between company A and D will then be deemed to have been amended to incorporate the new fallbacks. It's also important to note that the protocol isn't limited to ISDA documents. It also covers a long list of other agreement types, and some of the more common ones are listed on the slide, but that's not exhaustive. So it's important to look at the protocol itself and to see what are the agreements that it does cover. The protocol does not, however, amend documentation that covers cleared transactions. So cleared transactions will be governed by the rules published by the relevant exchange or clearinghouse. So the expectation is that those exchanges or clearinghouses, they will exercise their powers to amend their rules. So to the extent that their transactions incorporate SOR or other IBORs, they will amend those rules to incorporate the relevant fallbacks consistent with the fallbacks protocol. For parties that don't want to adhere to the protocol, but who prefer to individually negotiate with their counterparties to sign bilateral amendment agreements, ISDA has also published forms of amendment agreements for that. So parties can use that if, for example, they want to amend the terms of the protocol in some way to address their individual circumstances. So generally, the hope is that everyone will sign up for the protocol unless they have a specific reason not to, and they want to enter into bilateral amendment agreements. Right? But obviously, each counterparty has to look at its own circumstances and decide whether the protocol is appropriate for it. So for example, if a party has not much exposure to SOR derivatives, or it plans to close out exposure to its SOR derivatives sometime in 2021, and there's not necessarily a need to sign up for the protocol, right? Because after that, if you plan to enter into SOR derivatives anyway, there's no need for the protocol. Another example may be if you have a swap transaction that is intended to hedge, let's say, a loan, and the loan is pegged to SOR, but the fallback for SOR in the loan is something different from fallback rate SOR. So again, in that situation, you may decide that it's not appropriate to sign up for the protocol because you don't want this swap to be subject to a fallback rate that's different from the underlying loan. Okay? Okay, so this is the last slide for derivatives, and it's to talk about the timing for the transition. So when is this transition supposed to happen? So as I mentioned earlier, USD LIBOR was expected to be discontinued at the end of 2021. It's possible that that may now be pushed back, but the original expectation was that end of 2021, USD LIBOR gets discontinued, and therefore SOR gets discontinued as well, and therefore parties should quickly transition to SORA. They should not transition to using fallback rate SOR in new derivatives transactions because that's intended only as an interim rate. Right? And ABS has said that it will cease publication of fallback rate SOR after about 3 years after the fallback trigger date. But essentially, the message is market participants should still actively transition to SORA as quickly as they can and reduce their exposure to SOR derivatives by the end of 2021. Right? So banks are already offering SORA derivatives, and for those parties that want to clear their SORA derivatives, LCH has also started offering clearing of SORA derivatives since the middle of this year. Right? So the stated goal for ABS is to try and reduce banks' overall exposures to SOR derivatives compared to May 2020 levels to 50% of those levels by the second quarter of 2021 and 20% by the third quarter. Right? So that's what everyone is supposed to try to work towards. Obviously, that will have to happen in tandem with the transition to SORA in other markets. So for example, for capital markets and for loans, the same transition will have to happen, and hopefully the market for derivatives will then follow suit. And with that, I will hand you over to my colleague Glenn, who will take you through what's going to happen for cap markets.
Thanks, Francis, and good morning, everybody. I think Francis has provided some excellent clarity on the nuts and bolts of SOR and SORA. And I think a recurring theme will be that the same issues that arise in derivatives arrive in the other product spaces as well. I'll just do a brief walkthrough of the position in the debt capital market space. The capital markets chapter discusses the position in respect of 3 main areas: legacy products, the transition era, and the future. Firstly, when we talk about legacy products, we're looking at the current universe of securities that have been issued. But what exactly is affected? Simply, these would be any existing securities which fix coupons using SOR as a base rate on an ongoing basis. For example, floating rate securities that price on a quarterly basis, or perpetual securities which will be repriced in the future and that are meant to be repriced on the basis of SOR at that point in time. Now, when SOR gets phased out, what's going to happen to these products? It's certainly possible that these securities may have some form of contractual language providing for what steps to take to determine SOR if SOR itself were unavailable on the relevant screen page. Most would have some combination of steps to be taken. For example, looking at a replacement screen page, looking at a rate published by a recognized industry body, going to reference banks to get quotations, or possibly applying the SOR that was in play for the preceding interest period. However, these steps tend to be appropriate only for a situation where SOR is temporarily unavailable, and these legacy instruments are unlikely to have a language that deals with a situation where SOR has ceased to exist altogether. After all, it would not have been contemplated that SOR would fall away. Which then leads on to the question of what you should do. Well, if you don't have any existing floating rate SOR securities or any instruments that are going to reset in the future based off SOR, congratulations. The good news is you don't have to do anything. But if you do, you need to consider what SOR fallback language you currently have in your documentation. And you need to consider whether that will be effective going forward. We'd suggest you speak to your professional advisors to determine the appropriate course of action that needs to be taken in the future. And if you're a professional advisor, we suggest you speak to your clients. Secondly, we pivot into the transition zone that we're in now. Instruments do continue to be priced off SOR now, even with the knowledge that it's going away. But how do we ensure minimal disruption for these instruments in the future? Since around the end of last year, some issuers did already start including a certain level of fallback language that does actually contemplate SOR permanently disappearing. These were typically done with a more general slant of one eye on the ARC benchmark discontinuation language. Very helpfully, we now also have the benefit of more detailed SOR fallback language developed by SC-STS that market participants may choose to include in their platforms. And many participants have chosen to take this path. Capital Markets chapter sets this out in some detail. Now, this is obviously voluntary and up to you to include or adapt as you see fit in your platforms. But just to provide a quick run-through, the fallback mechanism is triggered by the occurrence of a benchmark event. And a benchmark event is considered to kick in when certain events take place, including the permanentization of USD LIBOR and the determination by the FCA that USD LIBOR is no longer representative of the underlying market. This deliberately aligns with the triggers for SOR and USD LIBOR derivatives contracts. Now, if we have a situation where a benchmark event is deemed to have happened, what next? The formulation contemplates the appointment of an independent advisor to consult with the issuer and to help the issuer determine the replacement rate. The independent advisor is to be an independent financial institution of good repute with experience in the local or international debt capital markets. Needless to say, the ABS member bank directory is a good place to start. Just to note that if the issuer is unable to appoint an independent advisor, then it is the issuer that is on the hook to determine the replacement rate. The hierarchy that the SC-STS formula puts up in determining the replacement rate is in order: the interpolated benchmark, which is appropriate when a specific tenor for SOR becomes unavailable, but other tenors are still available. Term SORA, compounded SORA, successor rate nominated by the central bank, the ISDA fallback rate, and finally an alternative rate, which is a bit of a catch-all final provision. All of these can be subject to an adjustment spread if deemed applicable. This hierarchy has been designed with a view to have, in the first instance, term SORA, a forward-looking rate, to be the replacement rate for SOR, which is also a forward-looking rate. So a bit more of apples to apples. Should be noted, however, that this order does differ from the fallback hierarchy specified in the ISDA supplement, which goes with, I believe, fallback rate SOR as the replacement rate. So take particular note if you're also entering into SOR reference derivatives contracts to hedge your securities. You may want to consider varying your benchmark replacement hierarchy to mitigate any potential mismatch between your securities and your derivatives. Finally, the chapter turns to the future. We're entering a new era of capital markets instruments that reference SORA as the base rate. As you know, the recommendation has been to go with compounded daily SORA, and using an average SORA reflects movements in overnight rates over a given period of time, and the intention is that this will smoothen out any day-to-day fluctuations over the period. As has been mentioned, compounded daily SORA is a backward-looking rate, so the rate of interest applicable to an interest period and interest amounts to be paid can only be determined at the end of the interest period. So with the different requirements of the different paying agents that you may have and the different clearing systems that you may use, there's no one universally accepted observation period at this point. But the main thrust is to allow logistically for a rate to be determined and coupons to continue to be paid on time. There have been a few issuances so far, with different approaches having been taken. The four options that are presently in the running, in no particular order, are firstly the lockout observation period. And I think Francis alluded to this earlier, where daily SORA is observed up to a certain number of days prior to the end of an interest period, and the SORA of the day is then locked in for the remaining days of the interest period. Secondly, the lookback observation period, where the SORA rate for each day in an interest period is based on the SORA rate that was in effect a certain number of business days prior to that day. So essentially, the observation period starts prior to the first day of the interest period and ends again prior to the end of the interest period. But that allows time for the actual interest amounts to be calculated prior to the end of the period. Thirdly, backward shifted observation period, which is similar to the lookback, except that the weightings in the compounding formula are based on the number of business days and non-business days in the observation period. And finally, the utilization of payment delay, which just means that interest payments are delayed by a certain number of business days, which is what is mentioned in the market conventions for derivatives as well. So far, we've seen lookback and backward shifted used in a few of the issuances that we have out in the markets presently. MAS's own SORA floating rate notes use the backward shifted approach, and they've now started publishing a SORA index which is compatible with this as well. And the chapter goes into greater technical detail on these four options, and as things develop, we'll see if the market coalesces around any particular one. And that's the scope of the capital markets chapter. I'm going to hand over to Chiwai for the next section on loans.
Thanks, Glenn. I'm going to just run through the issues relating to the transition from the perspective of corporate loans. And I think it's, and you will see that there are a lot of commonalities between what's happening in the loan space and that in the capital markets or the derivative space. But let me just sketch out what is the position at present in the corporate loans. I think for most of us who are practicing in the corporate loans area, I know there are a lot of practitioners out there in the audience. The common reference rate used in Singapore for Sing dollar loans would typically be the swap offer rate or the SIBOR. And the reason why these are chosen, obviously, is because they are transparent rates in the market on the screen, as opposed to, say, lending based on fixed rates or prime lending rates. And as far as SOR is concerned, as Glenn and Francis have already spoken about, because of the cessation of LIBOR, given that LIBOR is a component of the swap offer rate, likewise, the swap offer rate will cease come 2021 or maybe later if latest reports are hold true. And the next issue is what is the position vis-a-vis the existing loan documents, the typical loan documents that many corporate borrowers have entered into. It will usually contain a market disruption clause, providing, for example, that in the event of the cessation of the screen or unavailability of rates, the rate will default to the cost of funds. This is the default position, but it is neither contemplated nor desirable that this state of affairs continue perpetually. Reason is because the cost of funds is, number one, difficult to hedge, and secondly, there could be arguments, perhaps from the borrower side, that the usage of cost of funds perpetually is arguably something that is not contemplated and therefore a force majeure. The SIBOR is also not an option because it will be discontinued by 2024, as has been mentioned earlier. So moving on to the transitional period, the recommendation that has been proffered is that the fallback SOR will apply for legacy SOR loans. And why is that? I think for the same reasons that has been mentioned by Francis. The calculation of adjusted SOR is similar to SOR, and because the risk-free rate, the US risk-free rate is being used, the adjustment to the benchmark has already been worked into the risk-free rate. But it has to be noted that the fallback rate SOR is temporary, and the recommendation is still for parties to eventually transition to SORA. So how does one get to the position where fallback SOR is the default or is the fallback position? The reason is that, and the position is that there would be a need to amend the loan document to provide for that, because most of the documents that has been entered into to date would just be a usual market disruption clause without any provision for the transition to fallback SOR. In many loan documents that has been entered into in the past couple of years, parties have actually inserted language recommended by the LMA or the LMA, which provides for the replacement of screen rate in the event that certain benchmark event occurs. But this is not a panacea, because the parties will still have to agree on what is the resulting reference rate. What the clause does is to make it simpler for the parties to agree, because it only requires typically majority consent. The LMA has also recently come up with a hardwired language for the transition to risk-free rates. That is something that parties can consider using, but obviously has to be adapted for fallback SOR. So coming on to new products, the recommendation in the compendium is obviously for SORA to apply for Singapore dollar loans moving forward. And for this purpose, the compendium does set out certain conventions that are recommended to apply. One of the considerations that underpin the recommendation for SORA 1 is the urgent need for the parties to transition away for SOR for the reason that it will cease come 2021. Secondly, the need for consistency across currencies, products and markets. If other leading financial hubs are transitioning to risk-free rate, Singapore, I think, would and should also follow the trend. Thirdly, the alignment between the loan and derivatives market. And I think this is one of the key reasons why fallback SOR is chosen as the contractual fallback rate for the transitional period, as opposed to, for example, capital markets, which has taken a slightly different approach. It is therefore easier for corporates to hedge their exposure under an adjusted SOR using derivatives, using the existing swap that has a transition, that has a fallback to adjusted SOR. The next point has also been alluded to by Glenn. It is the question of how to give advance notice of payment to the borrower. As we know, SORA is an overnight rate, and it will always be calculated in arrears. And if it were to be calculated all the way up to the last day of the interest period, there will be insufficient time for the borrower to immediately make arrangements for payment. And the different methods to address this has been mentioned by Glenn earlier. And the options that are recommended as being suitable for the parties, without expressing any preference for one over the other, would be the look back with observation shift, which Glenn has called the backward shift, and the second method is the look back without the observation shift. The compendium also set out a table of the indicative terms that can be used for a SORA loan. The next slide just set out graphically the look back with an observation shift. And what essentially happened is that on any particular day, we take the rate on the day 5 business days before, during the observation period, and the weight that is given to that rate will be dependent on whether that day in the observation period is a business day. Question, why is 5 business days chosen? The answer obviously is that it corresponds to roughly 1 week, and absent any holidays, it will be the corresponding same day. So if it is a Monday that we want the rate during the interest period, it will be last Monday during the observation period. The advantages of using the look back with the observation shift is that it would be compatible with the usage of the SORA index that's being published by the MES. And secondly, it aligns with, as I said, derivatives which fallback, which is based on the compounded rate over a particular period. The disadvantage or the cons, typically from the lender's point of view, is that it would be harder to operationalize in the event of a prepayment, because the weightage that is given is the weightage in the corresponding day during the observation period. And it may result in the buyer or seller of the loan being over or under compensated. We have set out an example of how of the calculations in the compendium, so I'll encourage you to take a look at that. Situations where look back with the observation shift would be appropriate is where parties wish to use the SORA index. SORA index is a transparent daily data series that represent the compounding of the SORA every day. So it is very easy to derive what is the compounded SORA rate for a particular period by looking at the SORA index. So secondly, parties who want the loan interest payments to be better matched to the derivatives hedges would find a look back with observation shift more appealing. And thirdly would be where parties do not expect the loan to be tradable or to be prepaid. Typically, perhaps for bilateral loans, relationship loans that the bank will hold on its books for a longer period of time. The next diagram shows attempts to show a look back without an observation shift. And the difference from a look back with an observation shift is that the daily SORA reading is weighted according to the day in the interest period. So perhaps a simpler way to explain this is that on any day in the interest period, we just look at what was the rate 5 business days before. And if the day in the interest period that we are taking the SORA rate is Friday, the rate last Friday will given a weightage of 3 because the next 2 days are non-business days. This, I think, has been the approach that has been recommended in other jurisdictions because it gives the borrower and the lender a closer approximation of the computation of the interest during that period. But it remains to be seen, and it's up to the parties entirely to choose which observation, or to choose the look back with or without the observation shift as the transaction may require. The pros of having a look back without an observation shift is that, as I said, it aligns with global recommendations, both in the UK and in the US. And there are some template documents, a discussion draft of documents that sets out how this will operate. Secondly, it will be easier to operationalize the prepayment because the amount of interest that will be accrued and therefore is payable to either the seller or the buyer of the loan will correspond to the number of days during the interest period that the seller has held the loan for. The disadvantage of that is that it is less transparent because this rate, this look back without an observation shift will have to be computed by the agent or by the bank. There is no SORA index that can be used for this purpose. So situations where look back without an observation shift would be appropriate is where parties may wish to align with the conventions used in other major currencies. And secondly, in syndicated loans where loan prepayments or loan trading would be a lot more common. Next, I will just touch on retail loans. And the background to retail loans is that for many of us who are users of retail financial products, you get a much wider variety of interest rates ranging from fixed rates to floating rates to prime lending rates and so on. And one thing that's worth noting is that most financial institutions have actually ceased offering SOR retail loans since 2011. That's a long time ago. For retail loans, the recommendation is obviously for it to be a SORA-centered approach, given the discontinuation of SIBOR as well as the cessation of SOR. And the difference for retail loans compared to corporate loans, compared to derivatives, compared to capital markets instruments is the proposal, or I think that's already being put in practice, where the SORA is computed in advance. So and what that means is that the interest rate for the consumer loan that will apply for, say, the next 3 months will be the compounded SORA rate that applies for the period in the previous 3 months. So if the loan commences in July, for example, the rate applicable in July, August, September will be the SORA compounded rate 3 months prior to July, which is April, May, June. That's easier for consumers because it gives the consumer certainty of the loan well before the interest payment date for that loan. The compendium also goes to some length to explain and discuss how legacy loans should be handled by financial institutions. It has to be done in line with MES guidelines on fair dealing. What that means is that ample communication should be had with the retail clients, and it should provide options and information to the clients, for example, to remind clients or to inform clients that certain MES notices such as MES 645 dealing with the TDSR will not be applicable. It should also give consumer choice as to what reference rate they would like to opt for. But highlighting to the consumer that certain choices may have consequences. For example, if the consumer were to choose SIBOR, for example, the consumer should be alerted that SIBOR itself will cease after 2024, and there will then be a need for another discussion with the consumer on the applicable rate. With that, I've come to an end. We have all come to an end on the presentation on the transition to SORA for the different products. I think we will take a quick 15 minutes break. Is that right, Chicken? Before we resume with the Q&A. So we will resume at...
So thank you, Angie. Ladies and gentlemen, we'll go for a quick break, and the panel Q&A segment will commence promptly at 11:35. So it's a 10 minutes break from now. Thank you.
Hi, thank you for rejoining us. My name is Chi Kin, and actually for today, I'll be moderating this Q&A session. I really would like to thank the panel and actually all the teams that had put a lot of work into developing the market compendium. In particular, this was the effort of steering committee for the SOR to SORA transition, SC-STS, where all the product groups were developing the protocols that we are seeing now, and then the task of the legal subgroup is then to match up with the protocols. So a lot of people were involved in this, Allen Gledhill, of course, helping to hold the pen on the drafting, but I'd really like to thank Standard Chartered in relation to derivatives for guiding the product development and also the corresponding legal protocols and then implementing that with ISDA. OCBC for bonds in terms of leading again the product development and developing the protocols, DBS for loans, and UOB for retail products. With that in mind, I think that sets up the discussion for today. What we are trying to do is we're trying to take a horizontal look across all potential questions that may come up from a legal professional perspective, and to try to help the industry level set the knowledge base, but also come up with an aligned perspective as to how we move forward. We've spent most of 2020 making sure all the technical infrastructure is correct. Systems are being changed, products are being developed, legal conventions are being done, communications plans are settled, various agencies and bodies are communicated with. So now as we cross from 2020 into 2021, it's going to be important for us to get into transition, and make things ready so that we don't get a disruption come 2021. With that in mind, we'll go into Q&A. I'm joined, of course, by the A&G panelists from earlier, but also Joyce from DBS will be helping the panel, and Hui Kiao from UOB will also be helping on the panel. In addition, on the phone, we have colleagues from MAS, Alvin and Eugene, who I would like to prepare for one of the questions that I will ask later. I'll just ask the question first, let them prepare, and then we'll come back to them, okay? So Alvin and Eugene, one question is going to come your way in relation to the question on in terms of the ABS transition timeline to reduce SOR gross exposure, right? Is this based on gross exposure or is this based on gross notional? We'll come back to you on that question. Okay, but let's kind of like get into some of the more admin/housekeeping questions first. I think the first question that I like to deal with is this question here, which is, would the financial legal industry be overwhelmed by IBOR transition? And presumably you mean not just Singapore, IBOR transition as a whole, as we go into 2021, and hence corporates not getting enough timely support. I do think this is a very practical question, so maybe I'll get two perspectives on this, one from Allen Gledhill and then one from Joyce, okay? So over to Chi Wai from Allen Gledhill.
Yeah, thanks, Chiki. I think this question underscores the importance of all parties to look closely at their legal documentation sooner rather than later. I think when news that first broke out that LIBOR will be discontinued sometime in 2014, there was a bit of a panic, but that subsided as everyone viewed that the cessation of LIBOR will be sometime to come in the future, and perhaps by then many existing loans would have matured. But I think the reality is that the discontinuation of LIBOR is very imminent. How can corporates, putting aside banks, who of course will have their own systems in place, how do corporates or should and could react to this? Maybe I'll just answer it two ways. One, why should they? And secondly, how do they? Why is obvious in the sense that corporates would not want to be faced with a situation where the default rate becomes cost of funds perpetually. That gives uncertainty and it creates basis risk if the loan is hedged. How do corporates go about it? I would advise that corporates, especially those with large SOR loan books, with a variety of different types of documentation, to consult with whether it's the in-house counsel at the first instance, and secondarily with outside counsel if need be, and also importantly with their banks, to raise it with the banks, to ask about what is that bank's proposed approach, so that there will be no surprises come end of 2021. It does involve a bit of due diligence, not as much as banks obviously, who will have a huge loan portfolio. For a typical corporate, it will be necessary to pull out the loans that the corporate has, review them. It's not that many clauses, primarily zooming straight to the market disruption clause and see how that caters for it. See if there's already a replacement screen rate clause somewhere that gives the basis for negotiations, and take it from there. But clearly work, there's a lot of work, and that has to start soon.
And Joyce, would you have a bit?
Sure. I think on the bank side, a lot of the banks should have already started preparation work for a LIBOR transition. Regulators globally and here in Singapore have been talking to banks and reminding banks that they need to start early, get ready, and engage clients as soon as possible. So we believe that a lot of banks are working through things like resourcing. If we have a lot of bilateral amendments or repapering to do, they're working through systems and operations issues, and they're working through their client engagement and communication program as well. So it is probably right to say that the banking industry has started the preparations a little earlier, and maybe the corporates and the retail markets are catching up now. But I would echo, I think, what Chiwai said earlier, in that if your banks haven't reached out to you yet, then you should be reaching out to them to find out what their plans are, and get yourself in the queue as early as possible so that you can have that conversation about what your options might be. Getting in early would just mean that you have the ability to consider various different alternatives, as opposed to leaving it too late, and then maybe you're kind of left with a default position that may not be all that appropriate for you. So I think the industry is working towards beefing up resourcing and systems preparation. So I think we will be able to cope with it. It is something we've seen coming from a long way away. And we still have a little bit of time to get ourselves completely ready for that.
Yeah. And maybe on my part here, it is a risk. Yeah, so it's quite clearly a capacity issue, a systems issue, and possibly even a strategic issue, in the sense that we've all got to make our decisions, whether you're a bank or a corporate. What can help is that actually SC-STS has published a corporate user guide, which actually sets out in very, very lay terms the types of processes, the types of questions you need to be asking. And I think as a start, if this question was asked by a corporate, please read the corporate guide and make the decisions accordingly. While it is a risk, it is a reasonably foreseeable risk, and if you can foresee the risk, then we should be managing the risk accordingly. Okay, so I think that handles that question. Maybe I go into the questions now with the highest number of votes, and clearly that one that got a lot of votes was the question on the reduction of gross exposure. So I guess MAS colleagues, either Alvin or Eugene, the question is, in terms of the ABS transition timeline to reduce SOR gross exposure based on May 2020 figures submitted to MAS, is this based on gross exposure or is it gross notional reduction?
Thanks very much, Chikin. I hope you can hear me.
Thanks.
I'm calling from a distant location. So maybe let me provide some context, first of all, to the discussions at SC-STS with regards to these timelines, right? So, I mean, the timelines that SC-STS highlighted essentially were to help to drive the industry from its current use of SOR towards SORA, but also to reduce the risk that institutions face if they continue to rely on this SOR rate, which will be discontinued, right? And as with other jurisdictions, the recommendation in Singapore is to avoid reliance on the fallback as a primary means to transition away from the IBOR rate, SOR in our case. So, I mean, relying on the fallback approach increases risk to the institution in terms of operational risk with the sudden change in reference rate at the point of discontinuation, and it's also a change in reference rate that is the timing of which is outside of your control. So, as with other jurisdictions, the position within SC-STS is to go towards active transition from SOR to the rate that we are going to use for the market, SORA, for derivatives. And so with this in mind, and sorry, in Singapore, a further consideration also is that, the fallback rate to SOR for derivatives is fallback rate SOR, which is an interim rate, not meant for where the industry is going. The industry is going to SORA derivatives market. That's where the liquidity is going to be. That's where valuation of SORA contracts will be much easier than if you had to value a contract relying on fallback rate SOR. And so hence that there were these timelines to try to reduce exposures to SOR derivatives prior to the planned discontinuation of SOR. And in line with this, I guess the short response to that question would be, it would be more sensible then to reduce the number of contracts as well as the nominal exposures of derivatives referencing SOR. I hope that makes it clear.
Thanks, Alvin. And I hope that answers the question. I'll move to the next question, which I guess I will take, and then I'll throw it open to colleagues as well. The next question with the highest number of votes is this question on, with the whole transition, are there any particular areas for functions such as compliance and risk to focus on? And is there a need to implement any controls monitoring tools in place? The answer is yes. And I would say there are probably maybe 3 things to think about right now. The first thing that I would think about actually is in the immediate short term, right? And this is particularly from the bank perspective. The fair dealing and conduct outcomes that we need to achieve in terms of making sure we get ample time to the customers, very clear communications of options to the customers to let the customers or help the customers to make their decisions. The ability to manage, in a sense, customers which need perhaps more customized or more negotiated solutions. I think all those types of things are important considerations, and certainly something which I'm aware that many of my colleagues in the industry are quite focused on for 2021 as we go into implementation phase. It's one thing achieving a technical transition, but it's another thing also to allow the whole industry to get the fair dealing and conduct outcomes that we want. For this, I would also expect that SC-STS will be publishing further information as to how to achieve these fair dealing outcomes, to also sensitize banks to the expectations of what we should be setting out. It is not just something for the government or SC-STS to do. The banks do have a role here. Okay, so that's the first area I would highlight. The second area I would highlight is that as SORA becomes, it's an important benchmark already, right? It's been published by MES for decades, but it's quite important to reflect that as it starts getting widely used into documentation, then the relative importance of this benchmark is also going to be heightened. And that means also evaluating the benchmark processes against blue book obligations that we have as banks, and also taking the decisions as to how we comply with our blue book obligations with respect to SORA. And this would include baking it into testing or audit timetables to make sure that we're confident of the SORA processes that we're coming in. And the third thing that I'd highlight is I think we need to be sensitive to there's still going to be a transition period for SOR, right, where we go into fallback SOR. So we can't just discontinue all our SOR related processes immediately. In fact, those processes have to transition to fallback SOR first, and then after that, we've got to get ready for the final discontinuation of fallback SOR after its agreed shelf life period, which will be a decision that we take, currently expected for 3 years. Okay, so I hope I've answered this interim question as well on the transition. Okay, so the next question, which I think I'll pass to either Chi Wai or Joyce, will there be a publication of a SORA facility agreement in Singapore? Should we refer to APLMA or LMA for this? Chi Wai or Joyce, either one of you?
Should I take it? Okay. I think SG3, which is the corporate loans workstream, we have had occasional conversations with APLMA around Sing dollar facility agreement templates. So you would have noticed recently they published some discussion drafts of facility agreements using compounded daily RFR or a simple daily average. That was in relation to SOFR. So in our conversations with APLMA, our understanding is that they would focus on SOFR and SONIA, the US and sterling rates first. But they will be thinking about publishing Sing dollar documentation as well. I don't quite have the timeline for that yet, so I would say that that's something to keep an eye on if the new developments kind of turn up, and if SG3 continues to have conversations with APLMA about that. But what I do want to pick up, I think, is actually another question in the pigeonhole, which is somewhat related. In the market compendium, in the corporate loan section, you would have seen we've set out SORA loan conventions. A question has now come up about, are we going to look at fallback SOR loan conventions as well? And it is something that SG3 is looking into now, and thinking about putting a set of fallback SOR loan conventions out there as well. So again, that's something to look forward to. That may be good reference material for us when we're looking at fallback SOR loan amendments or provisions before we end up with either a fallback SOR or SORA facility agreement template from APLMA. So again, I think just to reassure people, the SG3 working group is considering these particular conventions and is aware that anything that we can publish going forward in the next couple of months would be helpful to the market. So keep your eyes peeled, or we'll make some further announcements on that.
Yeah, thanks. So I think actually as constructively as possible, right? I also feel that it's, in a sense, an area where SC-STS can help the industry, right? So we've got questions right now on legal capacity, cost of transition, protocols, conventions, that kind of stuff. So let me try to actually summarize a lot of those questions into maybe one or two points that I think can give a degree of assurance to the industry without detracting from the fact that the industry does need to get cracking in relation to the transitions, okay? So we do have a pool of conventions, and I think we do need to expect that those pools of conventions will converge over time as market take-up occurs, will also be refined over time as we identify new areas. So please expect that that market compendium document will continually be updated as and when we land on new types of conventions. The second thing that I think is appropriate is that since we can expect that there's going to be so much repapering or recontracting or renegotiation, right? I think one of the things that we can do as an industry is to align or coordinate these types of actions a little bit better, and without front-running some of the communications that we expect in the next few months, right? What I think the industry can take some level of comfort on, both banks and corporates, is it is not the plan for a market like Singapore to have every bank send out a different version of the letter to corporate customers, and then for those customers to have to process maybe 4 slightly different legal terms in the 4 proposed letters for transitions of facilities, right? That's probably not in the industry's best interests, because that's exactly what will happen. We'll get into this compare and contrast exercise between all the communications from different banks. That's not the plan. The plan is that we would try our very best to align these conventions, which is what is going on right now with SG3 and with SG4, and we'll publish. And as we publish, we'll publish these transition templates as well, so that actually borrowers can have the comfort level that the mechanism for transition is also something that cushions the legal effect of a lot of negotiations or actually legal fees. So that actually is the plan. I noticed quite a number of questions around this, maybe some with 1 vote, 2 votes, and I hope this kind of gives some level of umbrella comfort around the approach that we expect to take. Okay. Sorry. Okay, so I think GY, yeah, go ahead.
Yeah, it's definitely desirable for a standardized loan agreement, SORA loan agreement to be produced, hopefully by APLMA eventually, and I think steps are afoot to do that. But I just wanted to say that SORA loans are already appearing in the market. We have acted on some of them, and the changes are not that difficult. It's a question of using the LMA, the SOFRA and the SONIA one as an inspiration. The key for the banks and the borrower is to agree on some of the conventions. Of course, some of them are still in the process of becoming conventions. So parties do have to agree on this, but once these are agreed, the drafting of it is it can be achieved, but I fully echo what Joyce said, that it would be good for a standardized document to be produced that all parties can refer to as a reference point to minimize any deviation to the eventual language.
Thanks, GY. Okay, so we'll turn on to one of the other questions. Okay, so we're getting into this question which constantly comes up. So yesterday at the corporate guide webinar, the same question came up. So I think I'm going to point this question to Joyce and then possibly to MAS if they have input as well. Okay, so for SORA, will the credit spread adjustment be published by Bloomberg or MAS in future? And I think let's sweep up all the credit spread adjustment questions in one. Okay, so maybe Joyce first, and then I go over to MAS if they want to give input.
Okay, sure. The credit spread adjustment question in the fallback SOR space is something I think was touched on by Francis earlier. Because in fallback SOR we are taking in the fallback to US dollar LIBOR, which is adjusted SOFRA, that already includes the adjustment spread from US dollar LIBOR to SOFRA. That's part of the ISDA consultation that took place a couple of years ago, I believe. And the decision then was that the adjustment spread for US dollar LIBOR to SOFRA would be calculated using a 5-year historical median calculation methodology. So since fallback SOR we're importing adjusted SOFRA, we're going to take in that adjustment spread in any case. Now, if you're familiar with the ISDA approach, the other helpful thing about that is that those spreads will be calculated and published by Bloomberg. So for fallback SOR, it makes it easy in that we are already taking in that adjustment spread. For SORA, it is a question that comes up very often around how do you account for the differential between SOR and SORA. And it's pretty clear that the two things that are different is that in SOR calculations, you include a credit premium or credit spread and a term premium. But in a risk-free rate like SORA, you're not going to have that credit adjustment and you're not going to have a term adjustment as well. So it is something that the market, I think, is looking at. SC-STS and SG3, SG4 are considering and putting in a lot of thought about how do we best get to a landing, if possible, on what the basis for the adjustment would be. Otherwise, potentially you will have individual banks adding a slightly different spread to that. So it is a question that I think is still being considered, but I'm not sure if Elvin or Eugene have anything to add on top of what I've just said. It is something that I know we're thinking about, but haven't reached the landing yet.
Sorry, I was wondering if MAS also wanted to weigh in on that question. Actually, the other place this question will arise also will be in consumer. So I'm also going to maybe ask Hui Kiao for a view. I think there's one very important point here, which is that, look, we will need to make the decisions around this, but maybe MAS first.
Hi, Chicken. I actually don't really have very much to add to Joyce's very good answer. I mean, it is a very difficult, challenging issue. I mean, because once a number is stated, it affects a large number of contracts, both the borrowers and lenders, and counterparties to the contract. It is something, an issue that the steering committee is discussing around, but I don't think, and this is just me speaking, I don't think we would land on a single number, if that's the drift of the question. I don't think that's where we're going to hit, but the steering committee will probably provide some guidance with regards to a possible just to of legacy contracts. That suffices.
Yeah, this issue also has applications. Thanks, Alvin. Sorry, this issue also has applications into the consumer area, and I know that this is an area which SG4 has been really focused on, particularly because of the conduct overlay. And there's also a question in here around that. And so maybe we'll just wrap up the credit adjustment spread question and then the conduct question, whether this disadvantages the customers or not, and maybe pick Hui Kiao's brain in relation to the SG4 position on this. Hui Kiao, over to you.
Okay, thank you, Chicken. Okay, so in the consumer space, we have industry banks coming together to kind of like discuss the different options available, and we have actually given this a lot of thoughts in our meeting over the past year, and explored really all kinds of approaches that may be fair to customer. And it's difficult because between SOR and SORA, they are economically different, and therefore it is quite difficult to kind of pin down what is the basis risk, which is equivalent to the term and the credit premium, which is prevalent in SOR. So there are various approaches which we have explored. I don't think I will discuss this at today's forum because it is still pending decision at the SC-STS level, and we are pending guidance from the leadership. But I would just like to say that we have really seriously given this a lot of thought and a lot of debate around the industry banks. Yeah, so I think having gone through the exercise over the last year, the solution that we would be landing on, I think, would be really a fair one for consumers. We would not expect that there would be a lot of disgruntledness in that sense amongst the consumer market. So we have taken into account a lot of fair dealing principles as well. Maybe, Chikin, I'll just touch on that.
Sure.
So on the conduct risk issues that may arise, we have actually given a lot of thought to the MAS guidance around fair dealing. So what the subgroup is thinking of is that in the first quarter of next year, we will be going out to consumers with what Chikin has referred to as a template customer transition letter. And why are we going out in the first quarter of next year? I think the thinking is that we will give customer adequate time, up to maybe the third quarter of next year when we transition to the new SORA rate loans. Okay, so for consumers, we will be transitioning to SORA loans because that's in line with MAS SORA-centered approach. So that will give customers about like 3/4 of the year to observe the market and to see, what are the rates offered in the prevailing SORA packages by the different banks. There are already SORA loan packages on the shelf from OCBC, and in next year, February, when the other domestically, systematically important banks have to launch their SORA rate products, I'm sure there will be more products on the market for consumers to look at. So adequate time will be given to consumers and sufficient information as well for consumers to make a financially informed decision.
Yeah. So thanks, Joyce, for covering that. If I may summarize, right, we do need fair dealing outcomes from a customer perspective. We also need to be fair to the banks from a pricing perspective and from a credit risk perspective. And we do need to come up with an elegant solution to this that allows for an alignment across the industry and that minimizes the impact. Again, some of the questions are talking about what if customers are disadvantaged. I think a lot of this will be handled by giving a lot of ample time for the discussions with the banks. And then after that, making sure that we're aligned also in terms of the rates that we'll be coming up with. Okay, so that's the best we can do on that credit spread outcomes. What's the actual rate? Is it fair? Is it unfair? Type of question. We are aware that that question is constant. We are aware that that question is top of mind, and it's something that we are giving equally large amounts of thought and consideration to. Okay, so the next question, I think we've already covered this, right? Loan documentation conventions for fallback SOR, SG3. SG3 has that underway. The question after that, okay, so for existing loans, there is no hedging. No ISDA, right? If there is no hedging, does it mean we should transition to SORA rather than fallback SOR? Joyce again? Maybe I would, Glenn hasn't spoken anything, so if there's a bonds question, let's ask Glenn. Yeah, but maybe Joyce on, yeah.
I think the short answer there is yes. It is the preferred position that we transition to SORA as quickly as possible for all the product classes. And if you don't have a swap that is hedging a loan or a bond and doesn't need to match cash flows, or you are not so concerned with hedge accounting issues, then go to SORA as quickly as possible. So if you don't have any hedge at all, then go and talk to your bank about refinancing or a new SORA loan. And one reason for that is if you decide or rely on the default safety net we have, which is fallback SOR, you would potentially end up doing two transitions. If your loan is long dated, for example, you would have heard mentioned earlier, fallback SOR is interim. It is a default or a safety net. It has a shelf life of 3 years after it's been triggered. So if you do have a loan that's going to go on beyond that, you potentially find yourself doing two stages or two sets of repapering and transition from SOR to fallback SOR and then from fallback SOR to SORA. It will probably be better for all concerned and easier economically, administratively, documentation easier if you go straight from SOR to SORA if at all possible.
So I guess the big takeaway, I think I said yesterday already, is please engage the banks as fast as possible. Well, actually, please make your strategic decisions quickly, right? So take the inventories, what is your house position that you want to land on with respect to each of the facilities that you have outstanding. Once you've decided on that position, then please engage your bank to get the necessary support for the transition that's appropriate. We really had to cater for this prospect that, if you had to take an unacceptable, P&L or accounting outcome with respect to a hedged loan, which was currently on SOR, and given that the derivatives market is going to fallback SOR, we had to create that cushion of the loan also transitioning to fallback SOR to preserve that match. Now, if you don't need it, therefore, please engage your bank as fast as possible. Okay, so the next point, and this probably answers the other question also. Are amendments of loans for the transition usually initiated by the borrowers or the lenders? Actually, if you're ready, please initiate. If you're the borrower, please initiate if you're ready, right? The industry is very, very likely to initiate in probably Q1 next year when a lot of big communications will come out, and that will be after we have, crossed some of these difficult decisions around the fair dealing outcomes that we want, the adjustment spread, how to be comfortable with this, and how to align this with all the agencies that will have a view, no doubt, on whether this is fair or not. Okay, so please expect that there will be quite a lot of industry communication Q1 next year. But if you're ready, please engage the banks. Okay, so let's move on to another question. Okay, so there's 2 answered questions. The next question, okay, so there's a technical question here. The expected convention for derivatives seems different from ISDA's protocol convention. Does this mean for new derivatives contracts, payment delay keeps being the market convention for all currencies? I think some differences here that we need to explain. Joyce, maybe?
Sure. What you've heard Francis talk about earlier in relation to SORA swaps and the 2-day payment delay, that is the current market convention and practice that we see in SORA OIS swaps. But in the ISDA fallback protocol, the fallback for SOR discontinuing or becoming non-representative is fallback SORA, not SORA. So if you work through the ISDA protocol drafting, what you will find is that for fallback SOR, it is a 2-day backward observational shift calculation methodology in order to determine the rate to be used. So there is a differential between whether you're looking at a SORA swap or whether you are looking to a fallback SOR swap. But again, just to keep hammering the point home, fallback SOR is meant to be interim only, so they are meant for use in transitioning your SOR swaps, legacy SOR swaps, current ones, into an easier fallback SOR rate. We're not expecting to see any kind of market grow up or any new swaps being struck using fallback SOR. So the focus for new swaps going forward would be SORA, as Francis had described earlier in his presentation on derivatives.
Okay, so I hope that clarifies that question. So I'll go quite quickly through a number of questions. I think these ones have shorter answers, right? Is there an intention to build a calculator for calculation of a compounded in arrears SORA, similar to the Sterling RFR group? Joyce, I don't know if this is being taken by SG3 or no plan right now.
No plan right now. We do remind people that MAS is already publishing the SORA index now and publishing compounded SORA rates, 1 month, 3 months, and 6 months. So there are reference points where those are already available and you can look them up on screen. If you decide to refer to the SORA index or the 1, 3, 6 months MAS published compounded rates. So in the interim, I think there is still some help to the market when they want to have a look at what the rates are for SORA. But I don't think at the moment in SG3 we are considering a similar kind of calculator that the questioner had asked. I'm not sure if MAS has anything to add to that on their side.
Yeah, okay. So I don't know if Alvin, this calculator, that the Sterling group.
Hey, hi, this is Eugene here.
Hey.
Thanks for the question. Indeed, we have heard some feedback regarding this as well as from the yesterday's corporate masterclass. Let us take it back and explore with the various stakeholders and parties involved to see how best we can see how to effect this. I mean, it could be MES, it could be some other commercial providers as well, but we note the feedback and let us just take it back and consider it. Thank you.
Okay, hold on. Okay, so I'm just filtering through the questions. I'm trying to kind of like, which questions are, so if I may, right, this question from Ernest already has been answered. If I could trouble the admin team to mark it as answered. Okay, prepayments, break funding. This is very interesting. It might go back to Joyce again though. For outright SORA-based pricing, how are prepayments handled? Is break funding still relevant since this is payment in arrears? Yes, I think that's right, because it's a backward-looking rate and you can compute it. Any difference for SORA adjusted margin? This could be a level of detail that maybe SG3 hasn't landed on. Yeah.
The break funding question is one that has come up not just in Singapore, but in the US and sterling market as well. And I think they may be taking slightly different views. So there are points of view that say that break funding should still be something that parties need to consider, because there is still a cost to the bank when they're lending funds out, even if it might be on an overnight rate basis. Whereas, there is the argument the other way that the questioner had said, well, if it's overnight funding, then really how much cost would you suffer as a lender if I break my payments or I do a prepayment? So it is something controversial, I think, because there are opposing views. In SG3, it is a question on the table for SG3 to consider whether we can reach a landing to give some guidance in the industry about a position to take in relation to break funding. The alternative would be that borrowers and lenders will just have to reach a negotiated position themselves. One interim technique I think we may have seen in some of the pilot RFR loans would be lenders and borrowers agreeing just one prepayment in any interest period. So there's some control for both sides, knowing that if there's one prepayment only allowed in any single interest payment period, then perhaps the parties are quite happy not to go into the break funding conversation. But if there is the possibility for multiple prepayments, then that may be something that at the moment becomes a commercial conversation between the borrowers and the lenders. Chiwai, did you have any thoughts to add to that? Because you have seen some RFR loans.
Yeah, no, it is a live issue, and there are opposing views. I mean, strictly speaking, because this is not a term rate, unlike LIBOR or SIBOR. The theory is that the banks have not obtained match funding, which will be required to be broken in the event of a prepayment. So in theory, it can be argued that there should not be any broken funding. However, this doesn't take into account the fact that banks may still operate on a match funding basis even if the reference rate is SORA, because banks have, it's a prerogative of the bank to decide how and from what sources the funds are obtained from in order to lend to the borrower. So I don't think I have anything more to add than to say that this is a matter that has to be negotiated between the lender and the borrower. Hopefully over time, a consensus can be reached in the market that this should or should not be borne, or if should be borne only in limited situations, as something that all banks will abide by, whether or not that actually reflects their actual cost in the event of a prepayment. But that day may hasn't arrived yet. Over time, as more and more loan agreements get negotiated in the market, we might find a landing.
Thanks very much, Chiwai. Okay, so actually there's a bond question here, so if I could give Glenn a heads up. Okay, so what do I need to do for floating rate bond if there is no fallback provision in the documentation? And I assume this is an issuer asking the question.
A bond question, shocking. Thank you for that. Well, I mean, if we think about it and we go back to first principles, if you have a situation where you have no fallback mechanism, you obviously need to be able to build that in. Now, in a usual kind of, for example, in the loan construct, you would go back to your bank and enter into amendment docs to include that. The same principle would apply in a bond, just that obviously in this case now you're not reaching out to one bank, you're reaching out to your bondholders. So really you need to look at your docs and see how you would be able to do some kind of consent solicitation exercise such that you can introduce the conditions that will allow for the fallback mechanisms for SOR to be included, so that in the eventuality when SOR goes away, you're all lined up, your ducks are there, and you're ready to go.
Okay, thanks, Glenn. Okay, so I think we'll pick up some of these other questions. We're maybe in our last 10 minutes, so I'll just take up a few more questions here. Oh, there is a technical question here. So maybe Chi-Wai, you run through again, right, this question here. Please help explaining look back with observation shift and look back without observation shift. And I think you had some slides on it. Maybe I could just trouble you to run through those 4 slides again. Maybe if the admin team could help us to push those slides out. So, and all this is actually in the compendium with formulas and all that kind of stuff. So you can see it in the compendium as well. And it's also in the corporate guide. But over to Chi-Wai.
Yeah, it is a technical question. I myself, when I first came across this concept, I had to wrap my head in a little towel and really work out the worked examples. But maybe I'll just try to explain it maybe in a different way. A look back with an observation shift, let me just take another step back. The key here is to derive a rate that can apply to the interest period. Let's say the interest period is from 1st January to 31st March. We want an interest period to apply for this period. And the question is, how do we get the rate? That's one thing. Let me park that first. The second thing is, this rate is a compounded rate. So a compounded rate is a rate that is derived over a certain period and is compounded on a day-to-day basis. One thing to note about this compounding is that it only takes interest rates on business days. So if it is a non-business day, it will look at the overnight rate on the day before. So give an example, if the period in question is from this Monday to next Monday, we look at the SORA rate from Monday, Tuesday, Wednesday, Thursday, and on Friday, the rate on Friday will be given a multiple of 3 because it is weekend, Saturday and Sundays are non-business days, and then we take the SORA rate on the last Monday, which is the last day of the interest period. So that is how we get a compounded rate. Now let's apply that back to the interest period, the hypothetical interest period that I had from 1st January to 31st March. What is the compounded rate and for what period? The answer is that the period we use is the period from 5 business days before 1st January. Let's assume it is 24th December. And this period will end 5 business days before 31st March. Let's assume that is 24th March. We will therefore be looking for a look back of observation shift. We will be looking at the compounding for the period from 24th December to 24th March. Look at what is the rate on each of these days, and on any of these days during this period from 24th December to 25th March, if it is a non-business day, then we look at the preceding business day and apply the relevant multiple. We simply shift the observation. That's why it's called an observation shift. We look at the compounding day to day from 24th December all the way to 24th March. This is the rate that will apply for the interest period from 1st January to 31st of March. And that is why in the diagram, the period is the rate applicable, well, maybe that diagram is a bit too simplistic. So The example is what I have talked about. Let's contrast this with the look back without an observation shift. The look back without an observation shift will compound the interest rates from 1st January all the way to 31st March. The difference is that the rate on any of these days from 1st January to 31st March, the rate on any of these days is the rate 5 business days before. So let's say let's assume that 5th January is a Friday. We look at the rate 5 business days before 5th January. Let's assume that it is, let's say 29th or 30th December. Let's assume 30th December is a Thursday. The rate on 5th January will be the SORA rate on 30th December. And because 5th January is a Friday, we give it a multiple of 3. We give the SORA rate on 30th December a multiple of 3 to be the rate applicable on 5th January. Contrast this with the look back with an observation shift. We will be giving a weightage of just 1 because 30th December in my hypothetical is a Thursday. The rate therefore will be different because the rate on each of these days, and the key is that the weighting of the rate is different. I think statistics have shown that whether it is a look back with or without an observation shift, the delta, the difference is actually not that great. But I think the reason for choice of look back without observation shift is largely driven by the possibility of prepayments. I hope I answered that. To me, it's always necessary to have a quick look at a work example, which are available, I think freely available in a lot of materials, to fully appreciate how the computation works. But hopefully I've given a very broad overview of that.
Actually, thanks, Chiwai. I thought that was a pretty good deep dive of the issue. I don't think anyone else has something to add to that, right? Okay, maybe we'll just take one last question, if I may, right? So I think there's a conduct issue that's come up again, and so let's take it on. The question here is: I take it that the current loan contract will be varied, right, to accommodate the change from SOR or SIBOR to SORA. So there's going to be a transition from SOR to SORA. What recourse does a customer have, consumer, so I guess retail individual, what recourse would a consumer have if he finds out that he's disadvantaged because of this change? So I think maybe the first systemic point to make is that we don't want customers to be disadvantaged. So we're going to be giving plenty of time for these transitions to occur and for customers to make the correct decisions, what suits them on the packages that they want. Grace periods will be given, and avenues will be given for raising grievances or complaints if the customers find out that they don't really like the option that's given to them. There are always formal dispute resolution mechanisms that are in the market, and maybe at this point I would also say, actually I also feel that we need to distinguish between disadvantage because they've been treated unfairly, and in a sense perceived disadvantage because of economic volatility. As we all know, interest rates go through cycles, and it is probably factual that we're currently in a very low interest rate cycle. And so it stands to reason that at some point in time, that cycle will recover and we will get increased interest rate environments. And that doesn't necessarily equate to disadvantaging the customer. The fact is that the industry has moved from SOR to SORA, and actually the increase in SORA is a cyclical phenomenon rather than something which the banks intended. So with that distinction, the distinction between the bank treating a customer unfairly and in a sense an increase in rate because of economic volatility, I would say that those are two different things. Hui Kiao, you want to add anything to that?
I agree fully with Chicken. I think consumers will be given adequate choice. So we wouldn't want to see any disgruntled customers out there.
Okay, so I think that would draw us to the end of today. It's 12:30 on the dot. I still want to thank the panel, but I think I'll leave that to Mrs. Ong.
Yes, thank you so much, panelists, and thank you, Chikin, for a very robust discussion. So, ladies and gentlemen, we hope you had a fruitful and a useful time. And if you have more questions relating to this subject matter, please send them to sortransition@abs.org.sg. And today's session has been recorded, so it will be posted up on the ABS website by this Friday on the 4th of December. Now, I would like to remind you once again to please complete and submit your feedback on today's session via the Pigeon Hole. So it leaves me now really to thank Allen and Gledhill, the team, Chikin, Joyce, Richiao, for their time with us this morning. So I thank all of you for spending time with us and have a good afternoon. God bless. Bye. Blessed Christmas too.